Good morning, good evening, wherever you may be, across the nation or around the world. My name is Shane Squark, and on behalf of the CMT Association, I am pleased to welcome you back to another webcast as part of our educational web series. Today, on May 20th, 2020, we welcome Rob Koyfman as he presents Macro Views and Fusion Analysis, when every investor needs to time the market. Rob is the co-founder and CEO of Koyfin, which provides investors with tools to research stocks and follow market trends. He started his career at Goldman Sachs Investment Research in 2002 and later transitioned to a proprietary trading role in London. Following that, he worked as head of macro and thematic trading strategy at Citigroup and worked as a strategist at Caxton Associates, Lykesor Asset Management, and Technique Capital. Rob started Koyfin in 2016 because he was frustrated with the analytical tools available to most investors that don't have access to Bloomberg. In his spare time, he enjoys running on the beach with his dog Audrey and going to UCB improv shows. As always, we welcome you to submit your questions throughout the duration of today's presentation using the chat box to the right-hand side of your screen. In the interest of time, however, we may not be able to acknowledge all of your questions until the end of the formal presentation. Your participation in today's live webcast does qualify you for 2 CMT Association continuing education credits, which will be automatically added to your account if you registered with us online through the CMT Association website. And before we begin today, I'd first like to turn the floor over to another special guest we have with us. He is the Managing Director of Global Business Development for the CMT Association, Mr. Tyler Wood.
Hey, good morning, Shane, and thanks everybody for coming on to the educational web series this morning. I'm really excited to hear from Rob Koyfman. We've got a really action-packed hour, particularly given the market environment that we've been in here in 2020. So I'm going to keep my comments very brief, but hopefully they're related to everything that you're going to be learning today. I know we've got a lot of members of the association already on this call, but we've opened this up, and we've probably got several macro investors on here who may have never even thought about the CMT program today. So I wanted to take just 1 minute, give a few updates for you guys who might be interested. So really quick, we're going to talk a little bit about the Chartered Market Technician Program and really how people would apply technical analysis tools to their career path and to their investment management. We exist to help investors improve their performance and then also open up career opportunities. Being here on May 20th, 2020, the professional network of the CMT Association is still alive and strong, even though we've all been alone together here for several months. I actually first got to meet Rob Koyfman when he was a part of our symposium in 2019. Very generous supporter and really wanted to be there for the technical analysis community. And I think he's going to talk to us a little bit later this morning about how he found technical analysis and integrated that into his investment management approach. So we are really glad that you guys are here, committing your morning or your evening to your own professional development. And hopefully some of these tools that are in the CMT program would be applicable to you as well. So it's a very simple 3 steps for the exams to earn the CMT charter. We offer those exams every year in June and December. Unfortunately, given the circumstances this year, everyone who is considering the program for June 2020, we actually did need to postpone. All of our live test centers around the world were facing unprecedented public health risks. And I wanted to announce today to everybody who's on the line and hearing this recording afterwards, for candidates considering the December exams, the 1st through the 15th this year, we've actually been working diligently with our partners at Prometric Testing Centers, looking at all sorts of options to ensure that we can keep the program going for those who are looking to build their skills. So I'm happy to announce that in December, folks will have the chance to test either in a live test center, if one near them is open, or to sit for the exam through remote proctoring. There's a lot of detailed answers on our website about the specifications that you need, the attention to integrity and security that we've got for the exam. But if you're worried about commuting to a test center or being in a crowded space, you don't have to worry about that. You can take the exam right from your home or your office and make sure that you still have access to all of these great tools no matter where you are in the world. So let's dig in real quick. We'll just talk a bit about the value of the designation, what people are seeing in terms of career opportunities, how this helps them move through paths. Shane mentioned, in Rob's career, pretty impressive resume already, and he's just getting started. He's a young guy. But this is exactly the kind of tool that level sets you with the rest of the competing public in the industry, trying for those very competitive jobs. So folks who have earned the CMT designation, we've done a lot of survey work just about what happens for them in the first year after receiving the charter. Obviously, many receive promotions or move to new roles, new positions. Oftentimes, it's tied to a salary increase or bonus. You'll see the percentage weightings over on the right-hand side, that iceberg graphic showing us what members have received. But the one that I'm really attracted to, what was very meaningful from that survey data, was this question about more responsibility. And after receiving the charter, folks who are in the money management practice are either allocated more resources for their fund from within their firm, or they're able to attract more clients. So for those of you who are portfolio managers and considering what this volatility has done for your clients' faith and trust in your process, or even for your firm, you may want to consider the CMT program as a chance to improve your own investment performance and hopefully attract more assets to your fund. Moving on real quick, Rob is a macro investor and analyst. We've got folks who are single commodities, who are managed futures funds. We've got folks who are research analysts or client advisors running portfolios. And so it's important to know the CMT is applicable across a wide variety of career paths. So that's just a quick graphic for how that breaks down. We've got the top 15 employers of CMT charter holders, a lot of very familiar names for those of us in North America and Europe. Interestingly, the names are changing as employers throughout the Asia-Pacific region are becoming the leaders for employing CMT charter holders. We've been growing exceedingly fast across Asia, both in Hong Kong, Singapore, Mumbai, and I know we've got a lot of our friends from India on the line tonight. Very, very proud to announce that new office opened 1 year ago, and we're getting ready for the India Summit 2020, which will, of course, be a virtual event, but more to come on that. Really important, and I won't spend too much time on this, but the value of the designation is largely improved by the efforts of our board of directors, volunteers, and the small staff of the CMT Association. One of the critical things we do on behalf of charter holders is advocate both with employers in the industry, but also with government regulatory organizations. So in 2004, the board of the then Market Technicians Association went before the SEC and what became FINRA and argued that if they were going to test research analysts for their new Series 86 and 87 exams, they needed to test the technical community on our own body of knowledge. And that opened up a year-long debate about technical analysis as its own recognized discipline, equivalent in weighting and value as the CFA and the fundamental discipline. So I'm very proud that December 17th, 2004, they made their final arguments in front of the SEC attorneys, and they did agree that on Wall Street there are two types of analysts. One is a fundamental analyst and one is a technical analyst. Both are exempt from the FINRA Series 86 exam if they carry either a CFA or a CMT. And we've continued that advocacy work for years to come, working with IROC in Canada, with SEBI in India, Nebraska Department of Banking and Finance on behalf of all wealth managers, and the work continues. So we're very proud of our large volunteer network for helping us get through that. So those are some of the career paths, opportunities that open up. But what the heck is technical analysis? How would it possibly improve your investment performance? And we spent some time trying to define how we think about these tools and what people are learning in the program. And it was actually the work of Asaf Damodaran that really helped explain what we were trying to offer investors. And that is that technical analysis provides the tools to successfully navigate the gap between intrinsic value and market price across all asset classes through a disciplined, systematic approach to market behavior and the law of supply and demand. And I know that's a lot of fancy words, but if you think about how investors think about valuation, they're looking for a security that is undervalued and beaten down. Well, there are a lot of factors that drive that valuation, and there are a totally separate set of factors, the market sentiment, the mood, the supply and demand issues for individual securities that are driving the price. And oftentimes, price can be elevated way above or depressed and stay way below intrinsic value. And as the famous saying goes, the market can stay irrational much longer than you can stay solvent. And so what we're looking for is people to apply technical analysis, no matter what your other disciplines are, what other tools you bring to your investment process. It is a fantastic complement, and particularly for those who are of a fundamental background, as Rob was, and he'll share that story later. So what do you cover in the CMT program? You're going to spend a lot of time on risk management. We have adapted the CMT program as the world has changed over the last 30 years. Quantitative systems development, understanding backtests, Monte Carlo simulations, how to define a rules-based, repeatable system. I should note, you do not have to learn to code in Python to go through the CMT program, but you do understand the statistics and the logic behind how you would work in a system or evaluate someone who's offering you a system to invest in. It's all based around portfolio management, and we've really spent a lot of time considering what the academic community has come to a couple hundred years after the technical analysis community defined some of these traits of investors and behavior that guides price. We found some of those very, very helpful in relating why technical analysis works. So if the behavioralists call this the herding principle, we just translate that into price momentum. They're describing the exact same thing. So you'll learn a lot about what the academic community has derived from behavioral psychology and how that relates to the markets as well. We're not going to spend a ton of time on this, but I just really wanted to point out the cross-asset class, the intermarket analysis, the risk management that is covered in the program is a lot of what Rob is going to talk about today and what is in his process and in the Koyfin tools. It just felt like this was a really close fit for us today in terms of presentation. Here's a quick note just on what the program entails. 3 levels. You've got your textbook at each level, and we're just sharing the average passing score over the last 5 years, passing rate. So at level 1, 66% of our candidates are passing the exam every cycle, and it goes up from there. I mentioned the textbooks, the curriculum that you'll study from. This is a self-study program. There are lots of great folks out there who are teaching prep courses, and I encourage you to do your own due diligence. But what the CMT Association creates to help candidates prepare for the exam, what is the official guide for passing the test, is actually published by Wiley. Textbook at each level. We've transitioned over the last 5 years from a stack of really great books where you read a few chapters from each to a consolidated curriculum for everybody. If you are considering the program, you're looking to pick up the textbook, you can use that code CMT TW30, take 30% off at Wiley to get those textbooks in your hand. And that's efficientlearning.com is their site. You'll get plenty of links to that from the CMT Association pages. All right, and last but not least, I know Rob is a CFA charter holder, and we've had the great fortune of working with the CFA Institute for years, and I think they've come around and understood just how complementary technical analysis is to their own valuation and fundamental work. So if you are a CFA charter holder, you're actually exempt on the level 1 exam. You can start at level 2 of the CMT program. We've done a lot of curriculum mapping, and we understand that a lot of the same subjects are covered. So you don't have to take it just from me. All over our website, we've got great testimonials from money managers across the world who are both CMT and CFA charter holders, how the tools are complementary and what they have found value in from the CMT program in their own careers. Just short videos, and I encourage you all to go in and check some of those out from real practitioners who have been at this for a very long time. All right, enrollment is open. Exams are December 1st through the 15th, and we encourage everybody who is interested in learning technical analysis to take a really sincere approach to going through the material. And with that, I'd like to bring my good friend, Rob Koyfman, to the virtual stage here, and really excited about what he's going to share this morning in terms of his process going from the analytical world and working as a strategist with the Caxton Hedge Fund to then deciding to get into the software business. Oftentimes it's the reverse. There are great programmers out there who try to design software for the analysts of the industry, and I think Rob has got some real inside scoop on what it is that would be most valuable. So he's going to walk through sort of his approach and show some tools on Koyfin as he goes. So thank you all very much for being here, and with that, I'd like to bring Rob on.
Great. Thank you so much, Tyler and Shane. It's great to be here, and thanks for having me on. Really appreciate that warm introduction. I'm a huge fan of the CMT Association, huge fan of technical analysis. I'll go through my career in a little bit, but in my career, I've worked with a lot of talented investors, and I've worked with a lot of talented fundamental investors, with a lot of talented technical analysts, and really the most successful people that I've met had a combination of both, and really incorporated the two different styles. And so I'm a huge fan of technical analysis, and I like to marry it with the fundamental analysis. And that's really what I'm here to talk about today is my framework for thinking about market bottoms and bear markets. And this framework was developed kind of throughout my career and through the different experiences that I've had. But basically, a bear market is one of the best situations where you can use technical analysis because the price change tells you a lot more than the fundamentals do, and I'll go over how to marry those two in a little bit. So just to give you a brief overview of who I am and my background, that's a picture of me when I was still very well groomed. I don't look like that anymore. But basically, I started my career in Goldman Sachs in single stock research. So there, I came out of business or undergrad finance degree, was working on Excel models, looking at deep fundamental analysis, and really understanding how investors analyze company from a fundamental perspective. I also worked on the GS prop desk, looking to make macro investments for the bank's book. I then moved to Caxton in 2008, 2009, and that's really where I started learning technical analysis. And at first, I was very hesitant. I was very against technical analysis because I had such a fundamental background, and I basically thought at the time that everything was in the price, and price doesn't really matter. And then I sort of had my eyes open based on my experience at Caxton and how some of the traders there look at the world. I actually wrote a blog post about this a couple weeks ago. You can find it on our website. It's called "The Money Printer Goes Burr," and kind of described how I learned about technical analysis in 2009, and a lot of the analysis that I discussed today comes from that experience. I also worked in city options and ETFs, and also at a hedge fund called Technic Capital, which is a long-short TMT fund. So that all goes to show you that I'm not very good at keeping a job, but it also goes to show you that I've done a lot of things in my career and really looked at different styles of investing. And so there's not one style that's better than another style. I think they can be used for different things, and I think the real power of what I'm going to show you is marrying a lot of things together. Currently, I'm the CEO, founder of Koyfin. Koyfin is a financial data and analytics platform. Basically, we provide three three values to our users. Number one is really professional quality data on stocks, ETFs, mutual funds. So we don't focus on one particular asset class like so many other platforms do. We want to be cross-asset because that's kind of how I learned how to invest. But I think everyone today needs to be a macro investor, not just a specific stock investor or commodities investor or whatever it is. And so we have all that data on our platform, which is really cool. We built all our charting and dashboarding tools, and I'm going to be using those charting tools to demonstrate kind of the topics today. And then the third thing is our platform's pretty accessible and pretty intuitive. And so we really spend a lot of time thinking about how to make that intuitive and accessible, and we get a lot of positive feedback about that. And then lastly, I want to plug our Twitter account, Koyfin Charts, so please follow us there too. And I post a lot of kind of market analysis. So that's a good account to follow if you're on Twitter. And if you're not on Twitter, you should definitely be on Twitter because there's a lot of good content out there. So kind of the presentation is going to be broken out into three parts. Just going to quickly touch on what are economic cycles and why do downturns happen? Because I think it's very important to understand what are cycles, how do downturns work from an economic perspective, and then kind of dive deeper into more analyzing the specific turning points of a cycle and how to identify a turning point and what are the technical, economic, and fundamental things that investors need to look at to really understand when a turning point happened. So kind of taking a step back, and this is taking a big step back. If we think about GDP, what is GDP? GDP measures the economic activity of a country. It basically measures how much the company either produces or consumes, but broad strokes, it measures the economic activity of a country. And so you can see here that GDP over the long term actually is pretty steady. It rises at a pretty steady rate, and that's because GDP is pretty simple in terms of what drives GDP over the long term. There are three things that drive GDP. It's population growth, productivity growth, and money supply growth. Over the long term, those are the only three things that matter. So if you think about a country or a region, these are the biggest factors that go into the economy, is how many people are there to consume or produce something, how productive are those people, and how much money is in that economy. And this last part becomes a really important point for us, the money supply growth, and thinking about the different cycles and how to think about why economies actually deviate from this trend. The other thing, the important thing to notice here in this graph is there's a little bit of a paradigm shift, or actually a big paradigm shift. So you can see here before 1960, the cyclicality of the economy was much higher, and the cyclicality after 1960 was much lower. And there's a very important reason for that, and that very important reason is that central banks became much more involved in the economy. So I'm going to touch on that in a second, but that's a very important point to remember. If we took a step back in the last slide, we took a bigger step back in this slide, and this is 300 years of UK GDP. And you can see it's sort of the same thing. The economy was pretty volatile, or the growth rate is pretty volatile up until the past 100 years, and sort of over the past 100 years, that growth rate has become more steady. And there's a couple of things to understand or to think about of why that growth rate has become steady. Technology is one aspect of it in terms of innovation and information, and so people, I think, just know where we are in the economic cycle. You have better inventory management, better expectation management, so that's one key. But the biggest part of why that cyclicality has been reduced is really central banking. And so central banking kind of is a very long discussion that we can have on a very complicated topic. But basically, there's a couple of things that happened over the past 100 years. In 1935, the Federal Reserve was empowered with its current some of its current mandate, but basically 1935 was the first time that the Federal Reserve was able to do open market operations. So that was really important. Before that, the Fed didn't really intervene into markets. In 1971, very important, the U.S. Exited Bretton Woods. Bretton Woods was established in 1944. In 1971, the U.S. basically said, we're out of here. And Bretton Woods was an agreement where all the countries would be would be pegged to gold. So up until 1971, all the major countries basically didn't have the ability to print money. After 1971, the U.S. exited, and then some of the frameworks around Bretton Woods fell apart, but that caused a huge spike of inflation because the governments weren't constrained to be tied to gold anymore. But basically today, the reason that the money printer can go burr is because of 1971 and U.S. exiting Bretton Woods. And 2008 was really the first time that QE happened in the U.S. or a major economy, and obviously happening now in a major way. But these things are really important to remember and consider. If you think about this very kind of simple and basic diagram of what happens in an economic downturn, basically the economy starts to decline, and the economy starts to decline for a number of reasons, or for because of different reasons depending on the cycle. So today, the cause of that decline is obviously COVID, and you have a shock, so that's an event-driven decline. In 1990, the U.S. economy probably declined in the most natural way possible, and that growth just started to decline because it had been growing above trend for a prolonged period of time. So that was something where there was not a exogenous event. In 2008, we know that that decline happened because of a housing bubble, and basically asset prices were too high and caused that decline. But basically, economy declines for whatever reason. That causes asset prices to decline, and those assets are usually stocks, housing, or commodities, and those commodities decline, and that causes deleveraging. And this is a really important part to remember, and this is probably the most powerful part of an economic downturn. And that deleveraging happens in three scenarios. One is the financial deleveraging, so this is where companies are using less debt, people or consumers have less credit card debt, and that the reduced debt is because, one, it's less available, and two, the people and the corporations are more risk averse. So debt goes down and there's a deleveraging. There's operational deleveraging, which is very important. Operational deleveraging means that there's operating leverage in a company. Operating leverage means that for every $100 a company makes, the net income goes up by a disproportionate amount because the company has fixed costs. So just because revenue goes up doesn't mean costs go up, and that is the leverage or operating leverage. A lot of time these are people, so operating leverage involves hiring and paying people salaries. So when there's a deleveraging process, companies fire people, and that's obviously what's happening now, unfortunately, with all the unemployment. And then the last part is an investor deleveraging, with investors deleveraging in terms of their margin accounts, in terms of private equity firms going out and buying assets, or not buying assets in this case. So these are all important points, and that leads to further degradation of economic activity. So this kind of cycle goes on, and it basically stops when asset prices get low enough, and when this deleveraging basically stops its course. And as you can imagine, the higher the asset price bubble and the higher the leverage in the system, the more this has to unwind in this really nasty circle. And this is exactly what happened kind of in the 1930s. In the 1930s, you had a little bit of an asset bubble, but the system wasn't that leveraged, and you had a major decline. The US GDP declined by about 30%. And about 1/3 of the banks in the U.S. went out of business because there was just such a massive deleveraging going on. And prior to this time, there was no concept of a central bank stepping in and stopping that deleverage. So basically, around this time is when society, politicians, policymakers got together and said, this is kind of stupid, or it maybe doesn't make sense for nature to take its course, because you have all these ramifications politically and socially. So actually these declines aren't good for society. And that's when central banks basically evolved. And the way they evolved is basically to counteract this deleveraging. And the counteract to this deleveraging is the central bank injects liquidity and basically slows down this deleveraging. And think of it as like a pendulum, and it's a very slow-moving pendulum. It's how aggressive or how severe is the deleveraging versus how bad or how aggressive is the central bank's counter response to that deleveraging. And typically that counter response is pretty slow in previous cycles. Today that counter response is much more aggressive. By the way, I want to plug Ray Dalio's Economic Machine video, great free video on YouTube. So if you want to think about how to think about these cycles, then definitely Google it. I think it's 45 minutes long or something, but pretty good, and basically talks about this concept. Okay, so I know a lot of you are probably technicians on here, and I apologize for all this fundamental mumbo jumbo, but getting to the next slide is kind of thinking about or using 2009 as an example of what happens in an economic downturn. So this is U.S. GDP in terms of quarterly growth rate. You could see it's U.S. is growing kind of during this time. U.S. GDP starts to slow and it starts to decline. The Fed starts to lower rates to counteract that decline, and at some point that GDP reverses, and equities here signified by the SPX reverse also. So a couple of important points to remember here. Number one is the Fed response here is very gradual, right? So it's kind of like rates are here, then they lower rates, then lower rates, then they lower rates, and they actually start QE it around here. But the Fed response is pretty gradual. The second thing to remember is that the market bottoms before the economy. So notice here the economy continues to decline into the end of 2009, but the market bottoms in the first quarter of 2009. So the market always bottoms before the economy, and that's why technical analysis is so important to really identify when has the market bottomed, because the market is going to front run the economy or fundamental data. Now, the framework that I'm going to discuss with you today is really how to understand when the market has bottomed, because when we look at this picture, it's pretty easy for us to say, hey, the market bottomed here, so buy the market. When we're living it through it today, you actually don't know, are you here, are you here, are you here, are you here? And that's that's kind of the critical question, or the crux of what we're trying to understand is, when are we turning? When is this kind of like big shift happening of this decline to this recovery? And that's the framework that I want to discuss with you today. So the framework consists of four things. It's three technical things and then one fundamental group. And the three technical concepts are, is monetary policy doing enough? And the way that we could think about monetary policy doing enough is, one, we could forecast monetary policy, or we could have a spreadsheet to think about monetary policy. But from a technical analysis, we can monitor reflationary assets, and they will tell us when monetary policy is working. So that's number one. The second one is, when is deleveraging coming to a stop? So remember, we talked about that deleveraging as an ongoing cycle. Well, we want to understand, when is that deleveraging slowing? And the best way to think about that is credit. And we'll go over how to think about that in a sec. The third thing to think about is, when is the economic activity rebounding? So when is the economy, when are the economic indicators going to trough and going to rebound? And again, you could be a fundamental analyst or an economist, and you could have a spreadsheet and you could have a forecast, but the best thing to do, in my opinion, is to then follow the cyclicals, or track the cyclicals or cyclical assets, and they will tell you when economic activity is rebounding. By the way, this is probably the most challenging one to nail down, because there's a lot of moving pieces here. I'll go through that in a sec. And then the last thing, you should monitor fundamental indicators. So even if you're a technical analyst and technical analysis is your bread and butter, it's really important to monitor fundamental indicators, just as another data point or another arrow in your quiver to think about, when is the economy recovering and when is the turning point happen. And the biggest thing to remember with all this, with the fundamentals, is focus on the degree of change, the first derivative, and not the absolute number. And that's what a lot of fundamental analysts get wrong, is they focus on the absolute number and not the degree of change, and that gets you into trouble. So when we start talking about jobs today, or initial jobless claims or unemployment, a lot of people can't get bullish because unemployment is so high or jobless claims are so high, and that is a factually correct statement that they're high. But as I will show you, the most important thing to remember is the first derivative of those and not the absolute level. So let's kind of get into the first bullet point, or the first segment of what we're trying to identify. And the first thing we're trying to identify is monetary policy effective? Is monetary policy working? And when monetary policy is working, the market will start telling you, and the market will start telling you through these reflationary assets. And the reflationary assets that basically start working or start going up when Fed policy is aggressive enough are the ones that are linked to commodities. And so basically you want to monitor commodities to think about whether reflation, and reflation is this concept of the Fed being aggressive enough where the view of the market's view of inflation has shifted. That this is what you're going to want to follow to understand that. So in commodities, you could follow a bunch of commodities, but two of the best ones are copper and oil. Copper particularly very good to follow. Oil a little less effective to follow because there are supply dynamics that happen here with political and with Saudi Arabia and Russia and OPEC, but still good to follow. But copper is the one you'll want to follow. In stocks, my favorite stock to follow is Freeport-McMoRan. Freeport-McMoRan is one of the biggest copper producers in the world. So you have a stock that's producing copper, and that's a really, really effective way to think about whether the Fed is effectively reflating the economy. In ETFs, metals and mining, XME is an effective one. XOB is another one. And in currencies, you want to think about the currencies which have large exposure to copper, to oil, to metals, and that's Aussie dollar, New Zealand Kiwi, and South African rand. So these are all good currencies. So you can model or you can monitor all of these to think about reflation. Let me just go through an example of how to think about this in the context of in 2008. So if I pull up, and I'm going to do this pretty quickly, but you can create a free account and follow me at some point in creating this. So I'm going to pull up the SPX. I'm going to pull up Fed funds rate. I'm going to pull up the Fed balance sheet, and I'm going to pull up FCX. And for FCX, I'm going to just add relative strength to compare it versus the S&P. And let me just make this graph a little bit nicer for you. All right. So as I arrange these, all right. So what's going on here? Let me just kind of mention this. I'm going to make this a little bit bigger. This is the SPX. This is the Fed funds rate. This is the total assets of the Fed. So basically when these assets are going up, you have QE. This is Freeport-McMoRan, and this is Freeport-McMoRan relative to the SPY. So important to monitor the relative performance of Freeport. So if I zoom in here to 2008, I'm just going to show this as an example. If I zoom in here to 2008, as we saw before, the market starts declining in 2008. You have a pretty severe deleveraging. The Fed basically starts lowering rates. I don't see the Fed here, but the Fed starts lowering rates. And just, okay, so the Fed starts lowering rates over here, and you could see that over here. The balance sheet starts increasing kind of in late 2008. And Freeport-McMoRan, really interesting to watch. It's declining here, declining. And all of a sudden in December 2008, it sort of bottoms. And it makes a bottom, and it starts making higher highs and higher lows. And so as you know from kind of your technical analysis, a lot of ways to measure an uptrend. The most basic way to measure an uptrend is higher highs and higher lows. And you could see here Freeport in December 2008, 3 months before the market bottom, starts going up and starts making higher highs and higher lows. Freeport-McMoRan on a relative basis did the same thing. So versus the market bottomed in around December 2008 and started going up over here. So a couple of things to remember here. Freeport doesn't go up as soon as the Fed starts lowering rates. Okay? Freeport basically bottoms and it starts going up and outperforming the market when the market thinks the Fed has acted aggressive enough to turn the tide on reflation. So this is a really, really important indicator to watch. When has the Fed done enough, or basically when does the market believe the Fed has done enough? And the way you judge that is through technical analysis. So in 2008, this was a really good signal that it bottomed in December and started making higher highs and higher lows and basically started a new uptrend. If you fast forward till today, and if we look at it on a year-to-date basis, just put this. Okay. If we look at this today, you have a very definitive bottom here in Freeport-McMoRan in March 19th, 2020. So this is when the Fed started QE. And basically what the market has told you since March 19, 2020 is that the Fed has probably done enough, or the Fed has shifted the tide in terms of reflation. So Freeport-McMoRan made a low here. It actually bottomed relative to the market about 3 days before the SPX bottom, and has made higher highs and higher lows. So this is a really important indicator to watch as we're going through this recovery. And if this uptrend ends, or if this relative performance reverses, that's a really, really good sign that the market doesn't think that the Fed is doing enough, or the Fed maybe is about to lower its QE program, or maybe should increase its QE program. So again, really, really important to follow this technical indicator to think about monetary policy. So let me switch back to the presentation. That's on monetary policy, but you could do that with a bunch of these things. Freeport-McMoRan is my favorite indicator to watch here. On financial deleveraging, really good indicator to watch is high yield credit. So high yield credit, obviously the riskiest part, or one of the riskiest part of the credit structure. So that's the one that you want to watch, and there's a great ETF called HYG. So let me kind of do this analysis with HYG. I'm just going to change that over here, and I'm just going to take out this relative basis because that doesn't matter. And if we think about 2008, 2009 in terms of the experience, again, SPX makes some bottom in March 2009. What is HYG doing? Well, HYG makes a bottom on November 20th, 2008, and then declines with the market, but never makes a new bottom. So a little bit different scenario here, but as you can, well, on a relative basis, if you think about the market making a new bottom here and HYG not making a new bottom here, you could see here that this is a very interesting data point that the credit market has believed, or the credit market believes that the tide is turning, and that you basically go from a decline to recovery. So this was a really, really important data point to watch, that HYG never made a new low here. And I could tell you this was a really frustrating part for many investors because the market declined here. People thought kind of like, hey, here comes a second wave. But March, early April, if you were able to see this and analyze this, you basically, if you were able to take that cue from the credit market, you were able to ride the rest of this recovery pretty comfortably. So this is a really, really important asset to watch. If you think about what's going on today, if we look at it year to date, credit markets basically bottomed with the Fed. So the Fed basically started doing QE in March of 2020. And this QE is very interesting because it's actually focused on the credit markets. And so what the Fed has done is basically backstop credit, and the Fed has said, hey, we are going to lend an unlimited amount to almost any borrower who wants money. And you could see here that high yield has rallied pretty significantly. HYG is up about 20% from its bottom. So as long as this uptrend remains in credit, you have your second sign that the recovery is working and that credit is working. And so this could move sideways, or this could move a little bit up. But as long as it doesn't kind of like start trending down here, then we're in good shape for a recovery. And then if we do start trending here, it's really important to understand, is credit going to make a new low, especially versus the market? I don't think credit is going to I don't think HYG is going to go below 75. But as an analyst, as an investor who's watching the market right now, this is a really, really important data point for me to watch. And if credit does go below 75, then I'm going to have to revisit my bullish stance and my bullish view of the market. Okay, so second thing is is credit and financial deleveraging. And best way to monitor that is HYG. You could also use high yield spreads, but HYG very liquid, very easy to pull up. So make sure you're monitoring that. Third thing to think about is economic activity troughing? Basically, is there an economic recovery coming? And the best way to think about that is through cyclical assets. And unlike in the previous examples, there were only a handful of assets that you could focus on. With economic activity, there's actually a lot of assets you could focus on, or you could think about, and that's what makes this the most challenging, because there's so many different cyclical assets, and all the cyclical assets are a little bit geared towards a specific area of the market, that it's sometimes a noisy indicator to think about. So you have to kind of put the pieces together and really have a thesis on why certain cyclicals are outperforming and why other cyclicals aren't or underperforming. But in general, the most important thing to think about is to look across the cyclical asset class and to really understand, are some cyclicals making higher highs and higher lows, and why is that? And then why aren't other cyclicals making higher highs, and why is that? And you have to sort of put the pieces together. So in the cyclical sectors, there's a bunch of them to look at, but the most traditional ones are industrials, XLI, transports, IYT, financials, XLF. So these are kind of the important sectors to monitor. I like to monitor countries as well. So the most export-sensitive countries will tell you when cyclicality is turning, and two of the most important, or two of the most export-sensitive countries are Germany and South Korea, EWG and EWI. So you could look at that. And then the last thing, which I would really recommend that you do, is not only should you look at the ETFs, you should also look at the ETF constituents. You should look at the stocks and how they're performing, because that'll give you an idea of what's going on. So let's go back to our model here, and instead of HYG, I'm just going to change this to XLI, and let's go backwards 20 years, zoom out. And actually, let me add the relative indicator here, because that's pretty important here. And so that's going to be on the bottom, just top over here. No, I'm gonna get rid of this this and this, because you guys sort of know where kind of what happened here. So just give us a little more room to think about what's going on. But if you think about the SPX, again, bottomed in March 2019. If you think about XLI, and if you think about XLI on a relative basis, these were coincidental indicators, okay? So they didn't bottom before the SPX. They actually bottomed with the SPX, and they started rallying here. So this is why you have to look across the entire set. If you look at XLF, very similar dynamic. So XLF bottomed along with the market. If you were a market participant in 2009, you know that XLF was actually the cause of the decline, so it's very unlikely that it'll bottom. But if you look at the other asset classes like EWI actually did bottom before the market, right? So this is South Korea EWI, market bottoms in March 2009. EWI actually bottoms in November and never makes a new low. So this is why it's important to look across all the cyclicals, because some cyclicals will start working before others. And what you don't want to do is say, hey, this sector is not working, so that's why I'm going to be bearish, because there's always going to be a mixed bag, and it's really important to put all the pieces together. So you can see here in 2008, 2009, what actually happened was China had a big releveraging that they announced in 2008. So a lot of the EM-exposed cyclicals actually started performing much better than the overall market. So this kind of was important to monitor. But EWI was one. And then if we look at EWG for Germany, similar concept, a little less sensitive, but if you think about what happened, it made a new low versus the SPX, but on a relative basis, never made a new low and kind of traded sideways. So this was a really interesting tell in terms of Germany, in terms of what was going on then. If you look at it year to date, it's very coincidental in terms of what's going on. So EWG made a low along with the market on a relative basis, same thing, and it's sort of trading with the market. So I wouldn't say this is like the most bullish thing in the world, but it's sort of worth watching, and definitely worth watching if the market reverses, because these will reverse as well. If you look at XLI for industrials, very similar concept. So traded with the market, actually is making kind of consolidating sideways, not really going up, but not really going down. And actually on a relative basis, doesn't look that great. So this is a warning sign and really important to watch. Now, this is where it really helps to go into the stock constituents. So one way that I like to do that is we have a function here called lots of charts because there's lots of charts here. And so what you can do is you could pull up a ETF here and look at the constituents. So let me pull up XLI in terms of what the stocks looks like. So now I have all the stocks in the XLI. I'm sorting by market cap. You can sort of paginate through here, and let me make these a little bit smaller. And so this kind of gives us a much more interesting picture than the overall index, because actually the biggest stock in XLI is Union Pacific, which is a railroad company. That's pretty bullish. That didn't look like the overall index, right? Lockheed Martin, that's pretty bullish. That didn't look like the overall index. Honeywell is a little bit more neutral. It's sort of moving sideways. Triple M a little more neutral. These are all more neutral. But you can see here what's pulling down the index, right? Boeing is pulling down the index. GE is pulling down the index. Some of the airlines are pulling down the index. So if I look at IYT here, which is transports, you get a very similar mixed picture, which the ETF overall doesn't tell you, right? So for IYT, for transports, again, and this is, yeah. So for transports, again, the railroads are acting very well. This is a railroad, this is a railroad. UPS is sort of moving sideways. And then obviously the airlines are the biggest culprit for pulling the index down or pulling some of these sectors down. And that's not neither good or bad, that's just the reality. But you should be aware that there's a huge dichotomy in what's going on today with the cyclicals. If you just look at XLI, you could say, look, XLI isn't that bullish, or it's kind of moving sideways and underperforming, but there are a lot of bullish stocks in XLI that are telling you that there is a cyclical rebound or a potential cyclical rebound. The takeaway on the cyclicals, kind of, if we think about how to measure this, the cyclical picture is mixed. So whereas the other two, I'd say, was a pretty resounding vote for the market has turned, or that there's enough monetary policy was aggressive enough that credit deleveraging is not happening anymore, and that stopped. The cyclical picture is much more mixed, so this is really, really important to watch. So make sure you watch all these indicators and you watch the constituents as well as this kind of market recovery progresses to really understand, are we about to make a new bottom? And then the last thing I wanted to talk about is really on the fundamentals. So on the fundamentals, there's a lot of interesting things that you could look at. Don't ignore fundamentals. Definitely incorporate them into your analysis. But the most important thing to consider when you're thinking about fundamentals is, are the fundamentals troughing? And think about the degree of change. Don't think about the absolute level, because that's the most important thing. So you could do that for COVID cases, for example. You could do that for high-frequency indicators like initial jobs. You could do that for alternative data like open table bookings, which is restaurant bookings, which are publicly available, TSA traffic. And you could think about that for EPS revisions as well. So EPS revisions, very interestingly, is analyst estimates for EPS for companies. And so I like tracking these. These are really important to track. And again, I'm tracking the degree of change, not the absolute level of EPS. So let me go through some of these real quickly. So in Koyfin, I have a dashboard here that where I created COVID cases, which was a really interesting dashboard to monitor. That if you email me, I can share this dashboard with you. But if we look at this dashboard year to date, and I basically what I have here is all the countries. So these are all the countries. And on here, I have the absolute number of cases. And then I have the 1-day rate of change and the 5-day rate of change. So this is kind of important to monitor, or this is something that I've been monitoring very closely. And you can see here the most interesting part, or the most important part, is that the growth rate of COVID cases has declined. So on a 1-day basis, it was increasing in double digits. Today, it's increasing about 2% a day. This 5-day trend is much more smooth and much more interesting. And you can see that COVID cases have declined, the COVID growth rate has declined in the U.S. And that's a really, really important thing to watch. Don't get scared, or don't get fooled by the absolute number. This is a really tragic and unfortunate number. But from an investor standpoint, it's the change that matters, not the absolute number. And you could go through some of these countries, like Italy is another obviously example where this was a bad issue, and this was happening as well. If we look at jobs real quick in terms of another high frequency indicator, so let me look at jobs, which is IJC USA. Let me just put that on a new axis here, and I will make that a bar chart. Okay, so if I look at jobs, let's go back to 2008, 2009. I can tell you that as a market participant here, when we were sitting in March, all throughout the recovery, March, April, May, the number one thing you heard why people didn't want to get bullish is because the unemployment rate was so high. And the unemployment rate was very high. But the most important thing to take away as an analyst, as a technical analyst, is that this this jobless claims number is going down. So this trend is really, really important to watch to track the progress of the current recovery. By the way, this was also a really important indicator to watch. And if we look at, zoom out here, if we look at March, if we look at the 2000 recession or the 2000 bear market, so you could see here the market actually was declining for a long time, for about 3 years, for a number of different reasons. But jobs didn't have that same downward trajectory. Jobs had this kind of sideways trajectory, or initial jobless claims. And this was a really, really important sign that, hey, the economy is not really recovering. This is one of the things that you could have used to tell you the market hasn't really bottomed yet because these jobless numbers haven't gone down. And in 2003, the way you could have had confidence in that this market rally is sustainable is that these jobless numbers had started to come down. So if we look at it over the past year in terms of where we are today, the initial jobless claims are terrible. They're very unfortunate. It's really sad with what's happening in the economy. But the most important thing to remember, the most important thing to track from a technical perspective or thinking about this recovery, are these numbers going down, not how high these numbers are. So really interesting data point last week, and that this number was kind of sideways. And so over the next 4 weeks, I would really need to see these numbers to start coming down for me to get bullish or to think that this rally is sustainable. To the extent these numbers stay sideways, that would be a pretty bearish sign, and that's going to be reflected in some of the cyclical assets as well. So that's a really, really important thing to track as well. Last thing I want to mention to you is earnings revisions. So the way that you can track earnings revisions is on a company level. So if I look at JP Morgan, I can basically add EPS consensus estimates. NTM stands for next 12 months. And basically you could track what analysts are expecting for JP Morgan earnings for the next 12 months. And you could see that these numbers have declined, and rightly so, since March. But the most important thing to track or to analyze is this number flattening out? Has it stopped going down? And if you think about kind of what happened in 2009, this was a really important thing to watch, and not on an absolute basis. It didn't have to start going up, but all you had to be convinced is have analysts stopped decreasing their EPS estimates for the next 12 months. So this was a really important indicator to watch. And because this is on a stock level, you sort of have to do this for a bunch of different stocks. You have to look at it for, let's say, the top 50 stocks or the top 100 stocks. What I do is I have a dashboard here, and I have a dashboard here called, just find it here, called SPX, where I have my all S&P 500 companies, and it's just going to take a second to load. And while that loads, so what I have is the S&P 500 companies. I have my stock here, I have my EPS, and I have my revenue estimates as well. And what I like to do is I like to just go down the list of the highest market cap stocks, the largest stocks, and basically look at Microsoft. Microsoft's estimates are actually going up, right? So they're very well positioned for this COVID, largest stock in the S&P 500. Apple's earnings estimates are going up, and revenue estimates are going up. Amazon, interesting, EPS estimates are going down because they're spending a lot on COVID, but revenue numbers are going up. So this sort of tells you why tech is doing really well. This kind of explains the technical performance of tech, because the fundamentals are actually getting better in this environment, which is crazy. If we fast forward down, or if we go JP Morgan, which we looked at before, the picture is less bullish, right? Because even though the stock has bottomed, estimates are sort of going sideways. So that's neither, I'd say that's more good than bad, because they're not going down, and analysts are always late to revising estimates up. But these are sort of important things to track to make sure that the environment isn't getting worse. You could go down this list and look at a company like Disney, which obviously is very affected. And interestingly enough, Disney's EPS estimates have been flat, and its revenue estimates have been flat. So this is another thing to watch out for as you're thinking about the cyclicality of the current environment. Are fundamentals getting better or worse? These are daily indicators that you can track to really understand what's going on. So to sum it all up, or to wrap it up altogether, you want to use technical analysis in a bear market. It's much more effective than fundamental analysis. You don't want to ignore fundamental analysis, but you want to marry the two. And basically, according to our framework, there are 4 things that we talked about. Reflation and credit are giving you the green light, telling you that the market bottom is probably in, because the Fed has done enough and backs up credit. On the cyclicals and fundamentals, the picture is more mixed. So I don't know what's going to happen in the future. Nobody knows what's going to happen in the future, and the future is not written. It depends on the medical progress that we make with a vaccine or treatment. It depends on government policy, on opening up the economy. It depends on fiscal policy. It depends on monetary policy. So it depends on a million things that we have no way of forecasting. But the important thing is to track these on a daily basis and to say, are they getting incrementally better or worse? And right now, the cyclicals and fundamentals are mixed, and so we don't know whether you have the green light. My personal belief, or how I'm positioned, is that we probably have made a bottom, and that we will open up the economy pretty soon, and that we'll have a pretty major economic rebound as the economy defrosts a little, probably a W-shaped rebound rather than a V-shaped rebound. But these are really, really important metrics to follow to really understand and measure the progress in the recovery. All right, so that wraps up my presentation. Let me take any questions. All right, so first question comes from about gold. Is, do you include gold in the analysis as well? That's a pretty good question. I don't include gold in here, but you can include gold, and gold will fall into kind of this monetary policy tool in terms of when has the Fed done enough. The reason that I didn't highlight gold is because gold doesn't have a cyclicality effect to it like copper does, and that's why copper is my preferred asset or commodity to watch rather than gold. But you can use gold as well. Just be careful with gold. There are a bunch of dynamics that impact gold in addition to monetary policy. So there's liquidity, there's flows, there's a bunch of kind of weird things that gold does that make me a little less hesitant to do. But I can tell you that gold is definitely giving you the sign. So if we look at kind of our preview analysis in terms of SPX, and we look at GLD, and we zoom out 20 years again, and sorry, let me put GLD here. So one of the reasons I don't look at gold is, there were a bunch of weird things that happened with gold and positioning here that threw me off, and I'll fast forward to today as well. But you can see here gold actually acted pretty well in terms of telling you when monetary policy was effective. If you look at year to date, the same sort of thing, kind of gold bottomed when the Fed started reflating the economy pretty aggressively. So the bottom line here is that, and the gold miners is another one which is important to look at, which is a very kind of cyclical thing. So the gold miners here had a really big sell-off around here when people really weren't sure what the hell was going on, even though the Fed was acting pretty aggressively. So I would say gold is a good secondary asset to follow for monetary, but my preferred asset is copper. Second question, do you have any book recommendations for your own personal finance libraries? So there are a bunch of books. I wouldn't say like one is much better than the other. The two kind of references materials that I'll suggest for you is stockcharts.com has a really good educational component, and stockcharts.com, one of the founders of it, John Murphy, was one of the original or old school technicians. And so if you go to chart school and you go to overview and you read through all this stuff, this is a really, really valuable lesson or really valuable material to think about technical analysis. And then the John Murphy book, Technical Analysis. So this is kind of the Bible of technical analysis. This is the thing that I read, or when I started looking at technical analysis and someone said, you need to read this book. I think it's a good book. I think it covers all the different things about technical analysis. I don't think it's I don't think there's anything in there that's like earth-shattering or different than other books or that I've looked at. And it's definitely not different than just going here and reading this for free. But I would recommend this book if you're looking to have a reference material or reference piece for technical analysis. I really like the John Murphy book because that's what I read. Other than continue to monitor, what do you make of the relative underperformance of financials and industrials versus the SPX? Okay, so again, this is it's mixed. So when we look at the underperformance of financials and industrials, you have to look at the underlying currents within those sectors. So if I look at again, we looked at industrials, but if I look at XLF to look at the financials, the picture, again, is mixed. So I'm not ready to kind of, and the picture is mixed is because we haven't, there is no strong evidence of a cyclical rebound coming because there's so many uncertainties with opening up the economy both in the US and around the world. But if you look at kind of like the financials in terms of what the graphs look like, Bank of America sort of has trended up and moved sideways. You basically have sort of three different shapes here. The most common shape is this shape over here. You basically made a bottom and trending sideways here. So I wouldn't call this bullish or bearish. It's definitely concerning, but I'm not ready to kind of jump up and down bearish on it. You've had other things that have broken down. So Wells Fargo has broken down, and that's broken down because of its real estate and its exposure to the things that are COVID related. So I'm not going to look at a stock like, again, you could look at a stock like Simon Property Group, and this has not acted well. It's the largest real estate owner in the U.S. or mall REITs, retail owner. If you look at SL Green, it's one of the largest office REITs in the U.S., very heavy to New York. And so these aren't bullish charts, right? They sort of, actually, this could be a double bottom, but let's just say that to the extent it's moving sideways or testing its low right here, these aren't bullish. So these are really important to watch. So my takeaway from cyclicals is it's mixed. It's too early to say like, hey, this is bearish. It's too early to say the cyclicals are giving you the all green light. And that's why I put that yellow light on the cyclical assets. So that's why it's important to watch. And I'd say the situation right now is not resolved. Again, I don't know what the future holds. It could be that the economy opens up much quicker. We find a vaccine, whatever kind of the fundamental situation, or it could be we have a second wave or people are scared to do anything or whatever it is. So I have no idea what's going to happen. I'd say we're in a wait and see mode relative to cyclical assets. Can you share subscription packages for Koyfin platform? So Koyfin is currently entirely free. So you go on Koyfin, you sign up, you use it for free. We don't sell your data. We don't do anything evil to you. So definitely use it. In the future, our goal is to have a free platform or a free offering that's the best in the market. So think about all the kind of free platforms out there: Yahoo Finance, Google Finance, blah blah blah. We want to have a better free platform than that, and then we'll have a paid platform or paid packages, which basically give you more data, more functionality, more customization. So if you're a power user, then there will be packages for you to pay for. But Koyfin is currently free, and you could use that right now, and then the paid packages are going to come later this year. Is there a webinar lesson on how to use your Koyfin page? If you go to my YouTube videos, there's a bunch of videos on how to use Koyfin, and we'll be doing more and more. The best thing to do is to poke around and to kind of see what you get to. Where can I find Eurostoxx 50 on Koyfin? So in here under markets, if you go to world equity indices, I believe we have Eurostoxx 50 in here. So I don't see it. Let's see, stocks. All right, so we have the Eurostoxx 50 on here. I would just warn you, it's not live. It's end of day, but we do have this data here. So one way to search on Koyfin is you go on here, you type in what you want. So if I want stocks, you then filter kind of by what you want here, indices, and then you're able to find whatever you want. The other thing I would highlight is if you go to koyfin.com/directory, this is a directory page that we have. We lay out a lot of the different things that we have by category. This is particularly useful for like economic data. I use this all the time. So like if you're looking for jobless claims, our search needs to be improved. It's not that great. But if I were looking for jobless claims, I would click on United States, and then I would search for jobless claims or whatever it is, and it would find it over here. So let's go back to Koyfin. So I hope that answers that question. Okay, so I believe that's it for questions. I thank you very much for joining us on this webinar today. I hope that you're able to navigate these markets. They are very tough to navigate, but it's really important that you have a framework, that you marry technical analysis with fundamental analysis. If you don't have your CMT designation, definitely think about getting it, because you'll get the fundamental framework, you'll get the framework for doing the technical analysis. And it's a great organization and a great network, so definitely suggest you do that. And thanks for having me.
And on behalf of the CMT Association, I'd just like to extend our sincerest gratitude to you, Rob, for today's really, really outstanding presentation. For those interested, today's presentation has been recorded and it will be made available in our video archives over at cmtassociation.org by the end of the week. I know that there are still a few questions filtering in here, and if you have any more that you think of that we could not get to today, or that you think of while watching the archive, please feel free to email myself or any member of the CMT Association staff. We'll gladly pass them along on your behalf. Rob gave you the greatest offer possible today in saying that Koyfin is absolutely free for you to sign up and use. So I do encourage you to go to his website at www.koyfin.com, which you can see on your screen right now. Check out his platform. It looks outstanding, if you could not tell already from the webinar. And on his YouTube channel, there's some tutorials on how you can go ahead and use his platform. That will wrap up today's educational webinar series event. For the CMT Association, my name is Shane Skwarek. I thank each of you for spending the hour here with us and hope you enjoy the remainder of your day. Take care, everybody.